Welcome to the Money Matters Minute. I'm Gib McCarran,
I'm John Hardy.
and we're here this quarter to kind of give you an update on what's going on in the markets and how it may impact your portfolio. If you've kind of known how markets work in the past, if you look back historically, typically as yields on bonds go up, so does the stock market. The reason is that yields are going up because there's growth in the economy. What we've seen over the last 5 years has been sort of the opposite. We've seen the stock market go up as bond yields have gone down, and that's been mostly because of the Fed and the stimulus that's been provided through the QE programs. Well, over the last 90 days, we've seen that kind of what I would call the sweet spot that's worked over the last 5 years continue. And it's been good for not only the bond markets, but it's been good for the stock market, so that means it's been good for your overall portfolio. The three reasons why: there's a lot of money coming out of Europe into our markets, both the stock market and especially our bond markets, because Europe is having their bond yields go down at the same time they're seeing a slowing in their economy. China is actually seeing slowing in their economy, and they're moving money out into our treasuries and into our dollars. And then we've had the assurances from the Fed that they're not really going to do anything until 2015 or even into 2016. And on the stock market side, it continues to go up because of the quarter that we just came out of, which beat expectations, and then the looking forward over the next 2 quarters, it looks very good. We've again had assurances from the Fed that they're not going to do anything until they see inflation, and we've also seen Europe again to put money in our own stock market, while individuals that are left on the sideline over the last few years, our individual investors are putting money in the markets. All of this has been very good for portfolios and really where we're setting up over the next 6 months of the year. John, how do you think on the equity side we're positioned now and how that will impact portfolios?
I think we've come into this summer not addressing or not being concerned with the idea of sell in May and go away. We really came in realizing that what we needed to do is to find evaluations where we wanted to be in the equities if the second half of the year goes the way we plan. We believe it will be in a trading range throughout the summer, so what we're doing is evaluating portfolios. We're looking at equity positions. We're being sure risk levels are comfortable with clients and where they should be. And then we're looking at this economic data as it goes through the summer and gets ready for the second half of the year. If things go as planned, we would be a little more heavier in equities than we possibly are at this point in time. Not a lot, maybe 5% more. We would be emphasizing growth assets. We would be emphasizing foreign assets that are paying dividends. The value position that pays dividend is a place to be. And then the sectors that we have been, we'll continue to watch those. So we're looking at it, we're realizing in the summer we're playing down the fairway. We're on the left side, the right side, but we're in the fairway, and we're evaluating where we're going to be by the end of the summer with the economic data. Again, if it goes as we plan, we'll continue to push equities, but if we need to, we'll take a defensive position.
That's right, as we always do.
Right.
And on the fixed income side, we made changes in your portfolios. We've communicated to you through the last year or so, moving from interest-sensitive types of fixed income investments into credit-sensitive type of investments. And we maintain those types of positions because the interest rates are going to rise in the future. So we don't want to backtrack in order then to try to time it to get back out into the right assets. So we will maintain that. We do have flexibility in some of our fixed income investments that allow that portfolio manager to buy what he or she thinks they should be buying on the fixed income side, which may mean everything from treasuries to emerging market bonds to a whole lot of other type of fixed income things. But that flexibility in your fixed income side is what we need at this time, and that's what we're going to maintain over the next at least 3 to 4 months.
We'll go through the summer gathering information, keeping current on what's going on, reaching out to outside sources and being sure that we're thinking as other people are thinking, because as we go through the summer, we know it's your money.
And your money matters.